Sanctions usually target banks, oil companies, technology firms, weapons manufacturers. But what if the next target is an airport? Not a military base, a civilian airport. Because in today's world, infrastructure is power, and power can be restricted. Think about what actually moves through a major hub every day. Billions in trade, critical aircraft components, strategic cargo, capital flowing through sovereign-backed terminals. These are not just places where passengers wait for boarding calls. They are economic engines wired directly into the state. If geopolitics and aviation strategy are the kind of stories that keep you watching, subscribe, because this one runs deeper than you think. The next major sanction headline might not mention a bank, it might mention a runway. Airports are not neutral ground. Look closer, and every major hub is stitched into the fabric of state power. Who owns the runways? Who controls the gates? State-owned carriers anchor the schedules. Sovereign wealth funds back the terminals. Defense ministries sign off on airspace. Export corridors funnel billions through customs zones, all under national oversight. Is this just about moving people from A to B, or is it about moving influence, capital, and leverage? An airport isn't just a transit lounge. It is a financial instrument, a diplomatic tool, sometimes a military asset in civilian disguise. Behind the glass walls and departure boards, there is a web of institutional ties. Airlines answer to governments, terminals are collateral for state-backed loans, fuel contracts trace back to national oil companies. So what happens when policy shifts? When geopolitics turns hostile, the airport becomes more than a building. It becomes a lever, and every connection, whether carrier, fund, defense, or export, turns into a channel for pressure. Sanctions do not always mean closed borders or grounded planes. The real tools are quieter, regulatory, commercial, legal. 5 main levers: capital, leasing, insurance, payments, spare parts. Each one can choke an airport's operations without a single soldier or missile. Capital dries up first. Lenders pull credit lines. New bonds cannot be issued. Expansion stops. Leasing comes next. Most airlines do not own their planes. Lessors, often Irish or Singaporean, can repossess fleets overnight. Insurance follows. No hull or liability coverage means no legal flights. Payments freeze. Swift blacklists, blocked accounts, ticket sales stranded in escrow. Finally, spare parts. Export bans on avionics, engines, even tires. Maintenance cycles break down. Aircraft get grounded, not by sabotage, but by paperwork and supply chains cut at the source. It is a checklist, not a bomb. Each lever is a pressure point. Together, they turn a global hub into a stranded asset. The airport may still stand physically, but its strategic role shrinks. Money moves first, not planes, not people. Airports run on borrowed cash, billions raised in global bond markets, priced in dollars, euros, and yen. One tremor in investor confidence, and the flow stops cold. Expansion plans freeze. Maintenance gets deferred. Even routine operations can grind down to minimums. Heathrow is the case study. Owned by a patchwork of pension funds and sovereign investors, the airport floats bonds on the London and New York exchanges, 1.5 billion euros here, $1 billion there, and a green bond for good measure. Over half the investors are foreign. Every coupon payment and every refinancing round depends on market trust. When geopolitical risk spikes, spreads widen. There was a 45 basis point jump after the 2022 Ukraine crisis, and another 30 points when aviation technology sanctions hit. Each uptick means millions more in annual costs, money that should go to operations, now lost to higher interest. No shots fired, no runways bombed, just capital markets turning wary. The airport stands, but the leverage is financial. And when the money dries up, every other dependency, insurance, leasing, spare parts, grows more fragile. A mega hub rises from the desert, built for ambition, not just arrivals and departures. Al Maktoum International, designed for 260 million passengers, 5 runways, and a cargo spine linking Asia, Africa, and Europe. But what happens when global ambition meets geopolitical friction? This isn't just an airport, it's a sovereign project. Funding flows from Dubai's government, backed by the Emirates' sovereign wealth fund and regional banks. Every expansion, every new terminal is underwritten by state capital and international bonds. The bigger the hub, the bigger the exposure. Nearly 70% of throughput is cargo, electronics, pharmaceuticals, and high-value goods. The rest are low-cost, point-to-point passengers, feeder flights, and the promise of future Emirates consolidation. But with every new route, the web tightens. Foreign contractors build the terminals. Western insurers cover the risks. Joint ventures with European and Chinese partners supply the tech, the concrete, and the fuel. Al Maktoum's scale is leverage. Geography is leverage. But every connection, each financial tie, and every international contract becomes a pressure point. The more central the hub, the more visible the target. Insurance doesn't just cover accidents, it underwrites trust. No hull insurance, no passenger liability, no legal flights. That's the rule set by ICAO, enforced by every major jurisdiction. When a sanctions notice lands, global insurers Lloyd's, Munich Re, and Swiss Re issue exclusion letters. Coverage is revoked for any aircraft touching a blacklisted airport. Not just the home carrier, but every foreign airline, every cargo operator, every code share partner. Lease contracts trigger automatic repossession if insurance lapses. Airlines face a choice: self-insure at ruinous cost or ground the fleet. The numbers don't work. A single uninsured incident means catastrophic liability, hundreds of millions at stake. Even a state-backed carrier can't absorb that risk. Regulators move fast. Without proof of insurance, airspace rights are suspended, slots are pulled, payment processors freeze ticket sales. The airport goes dark, not with a bang, but with a letter from an underwriter. No coverage, no flights. The shutdown is silent, legal, total. Spare parts, avionics, software patches. Every modern airport depends on a steady flow of components, each stamped with an export code, each tracked from factory to tarmac. Who controls the pipeline? Not the airport, not the airline. The real gatekeepers are the original equipment manufacturers: Boeing, Airbus, Honeywell, Thales. Western firms with global reach, protected by export laws and licensing regimes. One denial order and the flow stops cold. No approved part, no certified repair. Mechanics wait for shipments that never arrive. Maintenance schedules stretch from days to weeks. Aircraft stack up in hangars, stripped for cannibalized parts. The paperwork piles up: compliance checks, safety audits, warnings from regulators. The spiral tightens. Every grounded jet means lost revenue. Every skipped inspection means rising risk. It is not just planes. Navigation systems, baggage sorters, even runway lighting all run on proprietary tech, locked behind service contracts and embargo lists. Without original equipment manufacturer support, the airport's infrastructure ages overnight. What starts as a delay becomes a shutdown. The metal is still there, but the hub is stranded, cut off from the global grid. Connectivity engineered out of existence. Sheremetyevo was a crossroads, 50 million passengers a year, half of them were international. Then sanctions hit. Foreign airlines vanished, 14 carriers gone within months. Lufthansa, Air France, Turkish. Schedules collapsed. International departures were cut almost in half. Over 300 Western-built jets were grounded or repatriated, stripped for parts, paperwork piling up. Aeroflot and a handful of others kept flying, but the network shrank to a skeleton. By the end of 2022, Sheremetyevo's international passenger count had dropped by millions. Flights were canceled, connections were lost, the airport kept its lights on, but the world moved elsewhere. Freight doesn't wait. When a hub is sanctioned, shippers scramble. Rerouting a single cargo lane can add 2 days, sometimes more. Insurance premiums spike, up 30 to 45% overnight. That cost lands on every box, every shipment, every supply contract. Investors notice. A single sanctions headline and capital starts to leak out. UNCTAD tracked a $4 to $5 billion drop in foreign direct investment after Russia's airports were hit. Logistics firms recalculate risk. Air cargo rates climb by 10 to 15%. Delay becomes default. The regional economy absorbs every ripple: higher prices, longer wait times, lost deals. One airport, thousands of downstream shocks. Isolation does not wait for a formal ban. The signal travels faster through headlines, risk models, and airline schedules. One warning from a regulator, one insurer pulling out, and the narrative takes hold. This hub is no longer safe. Confidence unravels, contagion spreads. Which airport becomes the next lever? Which coalition decides when connectivity turns into a weapon? A hub can lose the world long before it loses a runway. In an era where access is leverage, connectivity is currency, and isolation a weapon, which airport becomes the next pressure point? The answer won't come from the skies, it will come from the markets. The question is, who blinks first?